Back to a story that we are continuing to cover here and break down for you. Archegos Capital was forced to dump shares last week when it got into financial trouble. The stock market continues to be affected by this selling activity as prices of stocks like Viacom, CBS, and Discovery, they were sent crashing on Friday, with several banks also currently dealing with financial pain as a result. Joining us now to help us break this down further is Michelle Snyder, who is the partner and director of trading, research, and education for MarketGauge.com. Michelle, good friend of the show, thank you so much for joining us here today on this topic. Help us break this down a little bit more. What exactly happened and why is it so significant?
Well, Archegos went from being a hedge fund to running a family trust. And so basically that means that they had high net worth money and individuals, but no outside money. And what happens in that type of situations is they get specialized treatment. They're not under the same SEC scrutiny as hedge funds would be, and they get unlimited leverage. So that's exactly what they did with unlimited leverage. They went 5 times or more long Bidu, Viacom, Discovery, and others, which of course led to a margin call to the tune of $20 billion is what they lost overnight. The banks are involved because banks like Goldman Sachs and Morgan Stanley and Credit Suisse lent them money to meet the margins, which is why they've gotten hit. Now, what's interesting is Bill Wan himself had some red flags up before this even happened. He was already investigated for wire fraud, and he was banned from trading for 4 years in Hong Kong because of insider trading. So with these companies that go family trusts, they have very, very sort of opaque accounting without a lot of scrutiny, and this is exactly what happened.
Okay, and so I do want to come back to Bill Hwang in a moment here, but when we think about the fire sale that took place, is this a one-off or is this something that could have much more broader impacts beyond what we've already been watching in the markets thus far?
Well, we saw some of the impact already, obviously, but I don't think that it's having a major impact in terms of price. The market's already having other issues it's dealing with and has since even before this whole thing happened. That was just kind of another thing to deal with and maybe even a little bit of a red herring for what the other issues are in the market. But I think some of the implications could be actually positive. Because look at what's happened already this year. We had GameStop. So what did we discover with GameStop? That some of these companies had unlimited amounts of money to go short, 140% short, until you had the situation where the short squeeze happened, catching regulators off guard. And now we've had the opposite side. So we've had long and short with big money manipulating the market. So what could happen, what would be a good thing, would be that if actually some of this gets reined in by Wall Street, more transparency, and can actually work towards not only eliminating the distortions in the market, but make it a little bit easier for the normal retail investor to invest.
Certainly, and so some of the caution signs, and you may have alluded to one of them in Bill Hwang and the profile that he brings to the table himself, but what were some of the caution signs and why did banks overlook them?
Well, like I said, these people who have this high net worth money, they get overlooked with terms of regulations all the time. They've got a lot of money, so they give this specialized treatment to them. This is something that's been going on in Wall Street for a long, long time. So we've seen these type of blow-ups in the past. What makes this one so interesting is because not only did it happen so quickly, but right, it had this ripple effect in an already vulnerable market. But the specialized treatment that these companies get, this opaque accounting that they do, all of this is certainly not new, Brad. And I think the fact that it happened on the heels of GameStop and what that has exposed to some of these big net worth clients is a good thing overall, just to sort of repeat what I said before.
Certainly, and so I guess as a result, do you expect this to affect the due diligence that banks do before they even accept some of these margin loans that are required by a capital management firm to add certain names to their portfolio and then expect them to rise up?
One would think, especially if we get the SEC involved, that it would be smart for the banks to do a little bit more scrutiny, especially on these family-type trusts that have this unlimited amount of money with very little regulation. You know, that would be the smart thing, right? For banks to think twice before they get involved with this, especially since they're trying to crawl back from a really rough year. And they've been doing better lately. I wouldn't imagine why with the stress tests that they have coming up. and the fact that they're going to be able to increase their dividends and buy back their own stocks, why they would want to fuzzy the picture for themselves.
Nomura and Credit Suisse, what type of impact are we expecting there? What are they signaling thus far?
Well, I haven't looked at those two companies in particular, but I have been looking at Goldman Sachs today and Morgan Stanley, and they got hit, but they've held support at this point. So it'll be interesting to see over the next couple of days whether they hold the lows that we've seen over the last couple of days, because like I said, they have other things to look forward to based on what we just heard out of the Federal Reserve and what they're going to be allowed to do by June.
Absolutely. Just to add additional color to that as well, we do know Credit Suisse had said, while at this time it's premature to quantify the exact size of the loss resulting from this exit, it could be highly significant and material to their first quarter results. Additionally, Nomura saying that an event occurred and they could be subject to a loss of $2 billion based on market prices on Friday. So just to add that context to this broader conversation as well. When we think about, though, the event and this one in particular and how events like it could take place in the future and impact what we've seen over the past several weeks, which is a sputtering market that's struggling to get back to some of its highs or at least maintain those levels, what would you kind of round out the significance of an occasion like this taking place in the near future and its impact to the broader stock market that has struggled to find stability at some of those highs that we have been watching?
Well, I just want to go back to the point you were making about earnings with the banks
Sure.
and the bottom line that it might impact, because I think that's important. Because essentially what we know is that there's always the expectation, and then there's whether or not it exceeds or does better than the expectation. So I wouldn't worry about that too much, because now we've just set that expectation for it to be a huge loss. So I just wanted to say that. In terms of these type of events going forward, it's very possible they will happen, but again, you just hope that Wall Street gets smarter along with this. The big consequence of what happened after GameStop was not so much any kind of regulation to prevent these hedge funds from going short, but it was more attention to these Reddit kids and what they were doing and what that was legal. So really, it's a mind shift that we have to see all over Wall Street, which is some kind of accountability by these big net worth people who sort of get away with pretty much anything they want to until one day we get an event like what we just saw. So will it happen again? Yeah, but the awareness, the whole awareness of the market has changed a little bit this year, and I think that's all for the positive. So we'll see.
Michelle, appreciate the perspective and insight as always. Thanks so much for joining us here on Cheddar. It's Michelle Schneider, who is the partner and director of trading research and education for MarketGauge.com. Everyone, coming up on